If you missed just 10 days in the stock market over the last 20 years, you didn't just underperform, you ended up with a 10.6% loss instead of meaningful gains. 10 days out of 5,200. And here's the part that should make your stomach drop. 9 of those 10 best days happened during recessions or bear markets, right in the middle of the worst moments when every headline was screaming sell. That's what market timing actually looks like in the real world. Not clever, not strategic. A wealth-destroying trap that even the smartest people on Wall Street can't escape. Right now, with recession fears running hot, you are being sold a fantasy. The fantasy that if you just wait, if you hold your cash, watch the charts, and jump back in at exactly the right moment, you'll come out ahead. It sounds logical. It feels responsible. It is, statistically, one of the most expensive decisions a regular investor can make. We're going to break this down completely today. The data on who actually loses money trying to time markets, what dollar cost averaging really does to your portfolio during downturns, the psychological traps that hijack your decision-making right when discipline matters most, and then the specific playbook, the actual week-by-week, paycheck-by-paycheck approach for someone with a 9-to-5 job trying to protect and grow their money through a recession. Let's start with the people who are supposed to be the best at this, professional fund managers. These are men and women with Bloomberg terminals, research teams, decades of experience, and access to data you and I will never see. If anyone can time the market, it's them. So what does the data say? According to the Spiva scorecard, the most rigorous benchmark report in the fund management industry, over a 20-year period ending in 2024, 91% of active U.S. large-cap fund managers underperformed the S&P 500. Not some of them, 91%. And over a 15-year period, not a single U.S. equity fund category had a majority of active managers beating their benchmark. 0 out of 22 categories. Let that sink in for a second. The people paid millions of dollars to do exactly this. Pick the right times to buy and sell. Can't do it consistently? And you're going to do it from your phone on a Tuesday morning while the news anchor tells you the economy is collapsing? This isn't about intelligence. It's about the fundamental nature of markets. Markets price in information in real time. By the time a recession is confirmed, by the time it feels safe to buy back in, the recovery has already started. Every time. History doesn't give you a warning, it gives you a moment, and then it's gone. Now let's look at what regular investors actually do, and what it costs them. Dalbar has been tracking the gap between market returns and actual investor returns for over 30 years. Their most recent data is damning. In 2024, the S&P 500 returned 25.05%. The average equity fund investor returned 16.54%. That's an 8.48 percentage point gap, the second largest investor underperformance gap of the past decade. In 2023, investors captured 20.79%, while the S&P 500 delivered 26.29%. Another 5.5% left on the table. Over 20 years, the average U.S. equity investor returned 9.24% annually. The S&P 500 returned 10.35%. That difference sounds small. Compounded over 20 years on a $100,000 portfolio, it means the average investor ends up with roughly $40,000 less than someone who simply held an index fund and did nothing. Nothing fancy, no timing, no research, just holding. So where does that gap come from? Bad timing. Investors were pulling money out of equity funds in every single quarter of 2024, including right before major market surges. They got scared, they sold, and then they watched the market sprint away from them. Here's the brutal irony. The best days and the worst days in the market almost always happen within the same window, sometimes on consecutive trading days. You can't surgically remove the bad days and keep the good ones. When you flee to cash to avoid the volatility, you're almost guaranteed to miss the bounce. And that bounce is where your long-term returns actually come from. Pull up a chart of the 2020 COVID crash. The S&P 500 dropped 33.9% in 33 days. Fastest crash in history. Terrifying. Anyone who sold in March 2020 and waited until things felt safe to buy back in missed a 30% to 70% recovery rally. That's not a small miss. That's potentially years of returns gone because of one emotional decision made during peak fear. The same pattern played out in 2008. Investors who panic sold in March 2009, right at the exact bottom, locked in a $3,356 loss on a $10,000 position and missed one of the strongest bull markets in U.S. history. Every $500 invested at that March 2009 low was worth roughly $1,500 by 2013. The people who stayed in or kept buying walked away 32% ahead of those who stopped. The market doesn't care about your fear. It only rewards your patience. Now let's talk about what actually works and why dollar cost averaging is the closest thing to a recession superpower that regular investors have. Dollar cost averaging means investing a fixed dollar amount on a fixed schedule, regardless of what the market is doing. Every 2 weeks when your paycheck hits, every first of the month, whatever the schedule is, you invest full stop, no matter what the headlines say. The math behind this is counterintuitive, but it's real. When prices drop, your fixed dollar amount buys more shares. When prices recover, those extra shares multiply in value. You are, almost mechanically, forced to buy more when things are cheap and less when things are expensive. You don't need to know when the bottom is. The strategy does the work for you. During the 2008 financial crisis, a DCA investor buying into the Vanguard Star Fund consistently through the crash ended up with 1,046 shares by April 2009, worth $9,738. The lump sum investor who put everything in at the start had 880 shares worth $8,191 at the same point. The person who kept buying through the fear came out ahead by nearly $1,500. That's not a theory. That's what the numbers showed in real time. For someone with a 9 to 5 who can't watch the market all day, who doesn't have a lump sum sitting in cash, who just has a paycheck coming in every 2 weeks, DCA isn't a consolation prize. It's genuinely the best tool available. It removes emotion from the equation. It removes the need to predict anything. It turns a market crash from a crisis into an opportunity, automatically, but here's where most people derail themselves before the strategy even gets a chance to work. Behavioral finance research has identified the specific mental traps that cause investors to abandon good strategies at the worst possible times. 2 of them are absolutely devastating during recessions. The first is loss aversion. Studies going back to Daniel Kahneman and Amos Tversky, foundational work in behavioral economics, showed that the psychological pain of losing $100 is roughly twice as powerful as the pleasure of gaining $100. Losses don't just hurt, they feel catastrophically bigger than they are. When your portfolio drops 20%, your brain doesn't calmly process that as a temporary paper loss. It screams danger. It triggers the same neural pathways as a physical threat, and so you sell. Not because the math says to, but because your brain is running a survival program designed for predators on the savannah, not for bear markets. The second trap is recency bias. After the market has been falling for 6 months, your brain starts to assume it will keep falling forever. After years of gains, you assume gains are the new normal. Charles Schwab has documented this extensively. Investors who live through a severe market crash are statistically less likely to participate in the stock market afterwards and more likely to hold low-risk, low-return portfolios. The pain of the crash literally reshapes their financial behavior for years, even when markets have fully recovered and the rational move is obvious. Here's a fact that almost nobody knew in real time. In 2009, the year after the financial crisis, the S&P 500 gained 26.5%. While investors were still convinced the world was ending, the market had already turned. The people paralyzed by recency bias sat in cash and watched 26.5% walk away from them. Recency bias and loss aversion together create the perfect storm of bad decision-making. Markets drop. Your losses feel enormous. Recent history tells you markets only go down. You sell. Markets recover. You wait until it feels safe. By then, you've missed the best days. The Dalbar data is, in large part, a ledger of what these 2 biases cost people every single year. Now let's talk about asset allocation, because this is where a recession actually requires you to make one real decision. The question isn't whether to stay invested. We've established that. The question is what your portfolio should look like heading into a downturn, and whether your current allocation matches your actual situation. A 28-year-old with no dependents and a stable job has one correct answer to a recession. Keep buying. Every paycheck. Aggressively. A recession is a sale. Your time horizon is 30-plus years, and every dollar you put in at lower prices has decades to compound. You should not be moving money to bonds or cash. You should be treating a red portfolio like a clearance rack. A 55-year-old 5 years from retirement has a different calculation. You don't have 30 years for a recovery. If the market drops 40% and takes 5 years to come back, that hits differently. A standard rule of thumb is to hold your age in bonds. 55% bonds, 45% stocks, though many financial planners have shifted that to something more like 110 or 120 minus your age to account for longer life expectancy. The point is, your allocation should already reflect your time horizon before a recession hits, not after. Recession or not, the single most valuable thing you can do with asset allocation is rebalance. If stocks drop 30%, your equity allocation is now underweight relative to your target. Rebalancing forces you to buy more equities at lower prices and trim the assets that held up. Bonds, cash, defensive sectors. It's the mechanical version of buy low, sell high. No prediction required. And here's what often gets ignored. Recessions aren't all bad for every asset class. Historically, sectors like consumer staples, utilities, and healthcare tend to hold up better than the broader market during downturns. Treasury bonds often gain as investors rush to safety, which means a balanced portfolio with some bond exposure can partially cushion the drop. Gold has sometimes moved as a hedge, though its correlation is inconsistent. The key isn't chasing whatever held up last time. It's knowing your own situation and making sure your allocation serves your timeline, not your feelings. So let's get specific. Here's the actual playbook for a regular person with a 9-to-5 during a market crash. Step 1. Do not check your brokerage account every day. This sounds simple. It isn't. Every time you check a falling portfolio, you're feeding the loss aversion loop. Frequent checking leads to emotional decisions. Set a schedule. Once a week, once a month, and hold to it. Step 2. Automate your contributions. Whatever amount you're investing each paycheck, set it to auto-invest on payday. When the investment happens automatically, before you can second-guess it, the behavioral traps don't get a foothold. You're executing the strategy before your brain has a chance to veto it. Step 3. Build and hold a cash emergency fund before touching your investment contributions. 3 to 6 months of expenses in a high-yield savings account means you never have to sell investments to cover a car repair or a medical bill. The number one reason regular people are forced to sell at the worst possible time is that they have no financial cushion. Fix the foundation before you worry about the portfolio. Step 4. Don't try to rotate into whatever seems safe. The investors who shifted to cash in February 2020 and then tried to rotate back in when things settled ended up buying in at much higher prices than where they sold. Sector rotation and market timing are two versions of the same failed strategy. Stay broadly diversified, a total market index fund or an S&P 500 index fund, and keep adding. Step 5. If you want to do something productive during a downturn, focus on your tax situation. A market crash is an ideal time to do a Roth conversion. If you have money in a traditional IRA, converting it to a Roth while account values are depressed means you pay tax on a smaller dollar figure, and the future recovery happens in a tax-free account. It's one of the few moves that actually makes a recession financially useful. Step 6. Raise your contribution rate if you can. Even 1 extra % of your paycheck going into your 401k or IRA during a downturn can make a measurable difference in your long-term outcome. You're buying shares at sale prices. Every additional dollar deployed during a bear market has asymmetric upside. If there was ever a time to stretch your investment habits, a recession is it. Step 7. Don't let the noise cost you your career's worth of compounding. Every major market downturn in American history has eventually ended. The crash of 1987, the dot-com bust of 2001, the 2008 financial crisis, the COVID crash of 2020. In every single case, the market recovered, went on to make new highs, and rewarded the people who stayed the course. The investors who got hurt permanently were the ones who sold and never came back. The math on staying invested is not subtle. A $10,000 investment in an S&P 500 index fund in 2005, held through every crash and correction through the end of 2024, grew to $71,750. If you missed just the 10 best days in that 20-year stretch, you walked away with $32,871 instead, less than half, for missing 10 days. 10 days you almost certainly would have missed by trying to protect yourself from volatility. That is the true cost of market timing. Not the paper losses, the days you weren't there for the recovery. There is no bottom, not one you can reliably identify, not one the professionals can reliably identify. The bottom is only visible in retrospect, always in the past, always after the recovery has already started. Waiting for it is waiting for something that reveals itself only after you've already lost your chance. What you can do, what actually works, is buy consistently, buy broadly, stay diversified for your timeline, and keep your emotions from running your money. Those 4 things, executed with boring regularity through a recession, will put you ahead of the vast majority of investors who try to be clever about it. And honestly, that's harder than it sounds. Not because the strategy is complicated, because discipline during fear is genuinely difficult. So drop a comment below. Where do you find yourself right now? Are you tempted to pull back, to wait for the bottom, to move things to cash? Tell me exactly where you're at, because I think a lot of people watching this are in the same spot and could use that conversation. If this gave you a clearer picture of what's actually going on with your money, hit the like button and share it with one person who's currently panicking about their portfolio, because they need to hear this more than they need another headline. And subscribe if you haven't, because next week we're getting into something that very few people talk about: what to actually do with a windfall during a bear market, whether that's an inheritance, a bonus, or a settlement check, and why most people handle it completely wrong. The market will recover. It always has. The only question is whether you'll still be in it when it does.